consider this a professional courtesy.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker, licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. Welcome to it, everybody. It's been a week since we last spoke. Let's cover some of the interesting items that surfaced during that time. I'd like to thank those of you who reached out after last week's show. A lot of folks really wanted to chime in on that one, on the whole California hates you thing. And what's very interesting is how lopsided it was. In fact, it was almost 100% lopsided. I think I had one or two folks who sort of took the middle ground view, not to one side or the other, but the vast majority of folks who reached out after last week's show wanted to give me either examples of past times where California has really screwed us over in terms of we had rationing a few years ago, and everybody stepped up and did more rationing than the state asked for, and then proceeded to penalize us more for doing it. That was what one listener had to say. I had another listener talk about their plans to get out, that they're done, that with all the rules and things that they're putting into place, they're planning on getting out. And that was the more general tenor that, hey, I'm finished, I'm done. And these coming from folks who profess to be California natives and are looking to get out. So I thought that was very interesting. And I realized that for a lot of you, I know tons of you have no interest in California. You're not from California. You don't want to go to California, and with very good reason. And I get that. But there's one thing you cannot deny, is that there are folks outside of your region that absolutely serve as bellwethers or influencers for the real estate market at large, right? If huge financial bad things happen to real estate in big markets like California and on the East Coast, places like New York and other areas, there's typically at least some level of an effect, right? Maybe it won't affect your property values a whole ton, but it could have a very dramatic effect in your access to funds for purchasing, financing, for investments, what have you. So it's always good, I think, to get a national view, no matter where you are, and then keep your eye on several markets. Just like here on the show, I like to cover a variety of markets. I've got my markets that I think reveal certain interesting things going on in the marketplace. Las Vegas is one, for instance, that I like to look at. Just because I think it's one that really, if you look at it and you understand what's happening in those markets, or see those markets as getting hit negatively, those are sometimes leading indicators to other big things coming up. So today's show is going to be a little bit more step back and look at the big picture kind of thing, simply because we're going to talk a little bit about some things the Fed has just done. We have a very interesting head of the Fed now with what sounds like a different philosophy that could dramatically influence what we see coming down the pike. And what's interesting to think about is, what does that do in terms of accelerating a downturn in real estate? Now, we've talked about a lot of different folks presenting a lot of different theories about when we can expect a downturn. Things are very much inflated. Where did the policies that put forth by the Fed most likely affect us in real estate? And of course, lending comes to mind first. But in the case of big things like bubble popping, well, the last thing we had that happened in real estate was a gigantic bubble pop, right? So, and we saw what that did. So the idea of bubbles popping is a important one to keep in mind, because the one before that was the dot-com burst, right? Remember the dot-com boom and burst that happened in early 2000s? That was another one that really hit real estate. It didn't take very long. It only hit real estate for a year or two, but it absolutely had an effect. It definitely stagnated some real estate. It definitely brought prices down in many markets. So any bubble popping is something that we as investors, or folks interested in all things real estate, want to pay attention to, because these are things that could potentially indicate an opportunity to get better deals on real estates in various markets. Now, first on our hit parade today is sort of the continuing narrative around home sales and home inventory. An article or actually, you know, what's funny is about CNBC is right now they tend to do a lot less writing and a lot more simply posting of videos from their channel. But they had an interesting headline relating to the real estate market right now. This is an article that just came out. The title being "New Home Sales Still Well Below Historic Norms of Demand." Now, what's interesting about this is the disconnect that we see between the headline and the actual story, right? As we know, the actual story doesn't have anything to do with general demand, right? The problem that we face is that we don't have an inventory at the levels where there is huge demand. But now, to their credit, now I've been very critical of CNBC in the past because they've tended to do stories that simply imply that we see increases or decreases in the number of new homes getting sold based on demand of buyers. And while that is in a macro way true, in a micro way it's not. And they haven't been really pointing out the micro in past stories. But what's interesting about this story that just came out on June 25th is that they do give us that micro. And here's what it is, right? And oftentimes you can find opportunities in the margins of issues like this. So here's the lay of the land right now in terms of inventory. Builders remain building at historically low levels, no matter what you're talking about, right? We are at way less than even 20% of where we were at the peak of 2006, 2007. Now, do we want to be back to that peak? Well, maybe not. Maybe that frenzy fed some bad policies and maybe fed some bad habits. But we're not even at the level that would even come close to being on par with times when the market was simply considered healthy in the past. Now, for folks like me, that is scary because a lot of what I think is built up in this marketplace is by this ridiculously low level of supply that's coming into the marketplace in terms of properties. And all along, for the last several years on this show, we've talked about really there's only two ways to solve that inventory problem. It's either existing homes going for sale, sellers deciding to sell their home, or building more, right? And we talked about some other little edge cases like sellers being able to have in-law quarters or loosening laws and regulations relating to allowing folks to create resident suites out of their basements or other parts of their home or those types of things. But the reality is that we are simply not meeting the demand where the demand exists. We've talked about this before. We've talked about all the regulations and all the costs relating to building. And the more you pile those on, and remember, that solar stuff we talked about that's going to happen in 2020 is absolutely going to feed this monster. All of these things encourage builders to build higher end homes. Margins are lower on lower end homes, and the only way you can recoup a lot of these costs is to go for the higher end construction. And we're continuing to see that. We are not seeing any construction happening at the mid level of the marketplace. I've got a couple of new construction things going on here in my local area. None of them are single family residential. They're all higher density condo, townhome type situations. And they are priced at a point where it really puts them at the top of what should be the mainstream single-family residential price, which is to say $900,000. I recently sold a home that absolutely should not have sold for $840,000, but it did sell for $840,000. It was a single-family residential home, but here in Morgan Hill, anything from 800 to 840 should be what you pay for a single family residential home where you're not sharing walls with anyone. You get a backyard, you get a front yard. And what you're finding is prices higher than that where you get none of that. You're again in the townhome condo environment. So that's the actual best you can hope for if you're out there looking to buy a property. That's the best case scenario. So what we need to do is solve this problem of inventory. And it's not going to happen with a whole cascade of sellers jumping into the marketplace and saying, okay, we're going to go ahead and sell our homes now. We simply need to make it easier for folks to build. Everybody wants to attack this from the other end by making it possible for buyers to simply pay the higher price. And that is what got us in trouble last time. So that the lay of the land remains artificially low inventories, but plenty of inventory at the higher end. Now, what's interesting? Now, what might change? Here's the data that helps us get informed on what the margins might involve, and that's the areas between the change, right? We're seeing that home builders are seeing a decline in the level of sales happening at the higher end. So where these builders are trying to provide inventory, which is at the luxury level. And remember, luxury level is not a number I can simply give you, right? The luxury level for me here in Morgan Hill is probably about $1.1 to $1.6 million. Okay. The luxury market in Santa Clara is probably 1.3 to 1.7 or higher, right? For you, it might be completely different. In the city you live in, the luxury market might be 700,000 to 900,000 or in that range and up, right? So bear that in mind, and understanding where those margins are is a good thing to keep in your head. So what we're seeing is a drop of about 14%, according to the folks at CNBC, in sales at those higher levels in terms of new construction. Now, the question is, at what point do these declines feed the home builder beast enough to make them realize we need, despite the fact we'll take lower margins, I'd rather sell a larger number of lower margin homes to make the same amount of money than have sitting on the market for an extended period of time these luxury homes that are now not selling at the rate that we like. This is one of the things we talked about on this show a couple of years ago, are what would be things that would push construction into the areas where it needs to happen. And the argument I've always made is that inventory was so low that folks were willing to pay almost anything for a home once it was done being built. And it seems that in some markets, we have sort of reached that point. Now, I don't think we've reached that point in my marketplace. If you're a Silicon Valley person, we're not there yet. The homes that are being built are selling as fast as they can be built. So it's kind of nuts. But we are seeing in general across the country a 14% drop, which could be those first indicators that we are moving into a time when that will be the reality. Now, at the same time, we can have that conversation. We can listen to folks like Peter Schiff and other financial types who have called the downturns in the past. And we can maybe start to come to the conclusion we may be to the point where we're starting to see that pivot. Now, where do these experts call the pivot? Those folks are talking about a period of time from 2019 to 2020. So probably mid-2019 up through the end of 2020 is when the consensus is talking about the next big recession. How big? I have no idea. But everything is cyclical. We will see some level of a downturn at some point. I can say that with 100% certainty. It's just the timing. I called the timing. I thought the timing, we'd see that first indicator of this back in October of last year. We did not see that. So really now we have to just sort of keep an eye on what's going on with the marketplace and try to figure out where things will go less than when they will go, right? I think we have an idea that we know what the what is going to be, a decline, a slowdown, a pivot point. It's really more about when. So the when seems to be, by conventional wisdom, anywhere from a year from now to a year and a half from now, a year and a half to 2 years from now. I don't think there's anything unreasonable about that. The trends I'm seeing, the heat I'm seeing in the market where I am, it seems like things could continue to feed off of that for a while. And one other piece of interesting news that from the Association of Realtors is that new homes entered the pipeline in May than any other month since the end of the Great Recession. That's not saying much. And the fact that we haven't met this point yet kind of stuns me. Total housing starts increased 5% in May to a seasonally adjusted annual rate pace of 1.35 million units, the Commerce Department reported Tuesday. That marks the highest housing starts since July of 2007. So that still puts us at a ridiculously low point. Nowhere, it's still true that we're at a quarter, if you're being optimistic, of what we were at our peak. So still nowhere where we need to be, and also it's not just what starts are happening. It's what segment of the market those starts are aimed at. So those are things to keep in mind, and also things to pay attention to in your local marketplace as you're looking through it for investment opportunities or any other opportunities for yourself, or if you're a buyer and you're trying to figure out where you're going to go next. If you're currently a renter and you're hoping to buy soon, these are things you're going to want to keep in mind. Okay. Now, we're going to take a quick break, but when we come back, we're going to take a little bit of a step back and look at the economy in general. There is one very interesting indicator that also tends to feed this idea that we might be heading into something. There's a lot of things sort of happening now at the same time that are indicators. I want to share those with you so that you are ready. So don't go away. We'll be right back. Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner-broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909. Welcome back, everyone. Rebel Broker here with you, enjoying a fabulous venti mocha. Venti mocha. It's a large mocha Starbucks. Get over yourselves. Anyway, so what I wanted to do next is, and again, we're kind of taking big picture here, right? We've talked a little bit about broad things. When to expect downturns, what's happening with the larger construction market in terms of homes, what was the lay of the land as it is now, those types of things. Next, I wanted to take some tidbits from the economy in general and discuss them with you. And one that I came across, this was from June 25th, is an interesting thing that scares me a little bit. It's called the yield curve. It's the yield, according to this article, the yield curve depicts the difference in interest rates between long-term and short-term treasury bonds, which has proven to be a reliable indicator of overall economic health. Now, this is a topic I have seen before. The reason I've seen it before is because I saw it just before the last downturn. And what it basically means is that you see an inversion of these yield numbers between long-term and short-term treasury bonds. It doesn't happen very often, but when it does, it is usually an indicator of something bad coming. Now, instead of putting my spin on it, let me read from the article here to give you an idea of what this is. Quote, typically, when an economy seems in good health, the rate on longer-term bonds will be higher than short-term ones. The extra interest is to compensate in part for the risk that strong economic growth could set off a broad rise in prices known as inflation. Lately, though, long-term bond yields have been stubbornly slow to rise, which suggests traders are concerned about long-term growth, even as the economy shows plenty of vitality. At the same time, the Federal Reserve has been raising short-term rates, so the yield curve has been flattening. In other words, the gap between short-term interest rates and long-term interest rates is shrinking. So let me kind of lay that out for you. So if you graph these two things, if you graph the yield rate of long-term treasuries and short-term treasuries, there should be a distance between them, right? Well, what this thing is saying is that those two rates are coming together. And at some point, when they've come together and meet, that meeting tells you that you are getting the same rate of return for both a long and short-term investment in these treasuries, right? Well, why in the hell would you invest in a long-term treasury when you can get the same rate of return from a short-term treasury, right? But that's not the end of the scary news. Going on, unfortunately, the yield curve sank to an 11-year low last week, just 0.34%, a figure not seen since just before the Great Recession of 2007 and 8. However, it's not the flattening that triggers a recession. Instead, the powerful signal of recessions occurs when the numbers become inverted, or when long-term interest rates fall below short-term interest rates. So imagine that. Locking your money into an investment for a longer period of time nets you lower interest rates, lower returns than short-term rates. Right? Now, why is that Nuts. Well, because we've got history to rely on. The San Francisco Federal Reserve published a study earlier this year that revealed that an inverted yield curve has correctly predicted all 9 economic recessions since 1955. So this isn't guesswork. This isn't there happened to be a eclipse the day before there was a flood kind of stuff. This is not, a redheaded kid moved in down the street and you lost your job and there's supposed to be some causality there. No, this is over and over again. This occurrence has preceded economic recessions. So it's happened enough times that I think it is worth sitting up and taking notice when it does happen. So I'm going to suggest that if there's something you Google on a regular basis, or if there's news that you consume each morning before you get going, do a little Google on what is the current yield curve looking like. Because I think it's something we should be keenly interested in. Now, according to this, it correctly predicted all 9 economic recessions since 1955, with only one false positive in the mid-'60s, when an inversion was followed by an economic slowdown, but not an official recession. So, in every case, bad things happened. In one case, it didn't get as bad as it could have gotten. On average, the study found the delay between a yield curve inversion, and this is the sexy bit, right? Because it's one thing to be able to say, this is the harbinger of a bad thing, right? This is the thing that you will see. It is writing on the wall that something bad is likely to happen. On average, once it happens, you start to see the bad stuff happen in 6 to 24 months. So, boo-hoo, bad things are going to happen. Good news, you have plenty of time to prepare for it. This is not one of those things where it happens and 3 days later, it's too late for you to do anything, right? When you see this inversion occur, you know you've got 6 to 24 months before we start to see a general downturn. Now, what do you do with that information? Well, one thing we know is that in one out of all the times in the past, since 1955, it wasn't as serious, which didn't equal a quote-unquote official recession. In every other time it did, what you would want to do is take steps to guard your assets in a situation like that. Now, if you're in one of these super inflated markets, if you're in my market, I would like to suggest that you evaluate whether or not it makes sense for you to continue to hold on to the properties you have here when that first bit of inversion occurs. I'm in a mode right now, just with what I've known up till now, regardless of this yield curve news, that it's time to sell. And lucky for me, my circumstances have been. I didn't do it last year like I was planning to do it. Haven't done it yet. I have had a couple of interesting little sticking my toes in the water in terms of having folks come in and look at the property for purchase, those types of things. So I've been sort of private showings. But it's been impossible to get anything done with my kids in the house, and they're on their way out. All of my kids will be off to college this year. So I'm kind of synchronizing those two things, and the timing seems kind of perfect. So anyway, that's a whole other story. But I'm a little bit superstitious about talking about deals that aren't done. So I'm tending to try to keep myself from doing that. I apologize. Of course, anytime I get a deal done relating to stuff that I think is interesting to you, I'll of course share it with you. But I like to have it closed before I do that. So for me, the timing here actually sounds pretty good. So even if we did see this inversion occur tomorrow, the timing still works for me in terms of going onto the timeline that I think makes sense for me to do that. And so what do I do? Now, I have plenty of listeners who reach out to me that they're on board. They're done. I have a listener who lives up in Sacramento who's like, I'm out. I'm done. I'm going to sell and I'm going to hold on to the money and I'm going to ride it out and then see if I can't take advantage of a downturn in the market. I've got folks like that all over the place. I've got folks doing that in Gilroy. I have folks doing that in San Jose and Saratoga. I have one investor who owns 4 homes in Silicon Valley, which probably comes to, and once you take care of all of his debt, he would walk away with probably $3.5 million. And we sat down last weekend and did the math on how the money that money would work for him in other marketplaces. And he was pretty stunned. So anyway, he's looking at potentially liquidating those and moving out of that market altogether. All right. So what am I trying to inspire you to do? Reevaluate your current standing, or assess your current standing. I'm not even going to suggest that you go in there thinking I need to change X, Y, and Z. What I want you to do is assess what you currently hold. Look at what you have. Look at what you want. evaluate your rates of return. You'd be stunned if you knew how many investors I've talked to who don't know their rate of return on the cash they have invested in their property, or who have incorrectly calculated it because they haven't taken into account all the money that they put into these properties. So make sure to do that. Calculate how much you're making off of your property come the end of the year and see if it's a return that makes sense to you. Are you only making 2 or 3% on your properties? Well, you shouldn't. You should be making more than that. And it depends on what number you want to settle on. I have some folks who are perfectly happy with 5%. I have other folks who will not even get involved unless they can pull 10% out per year. So do that evaluation and then figure out if there's ways you could do this that make sense in other marketplaces. And if you're in a position where everything is positive cash flow, and even if you calculated a downturn of 25%, you'd still be absolutely fantastic. Maybe you don't want to make the change. Maybe the stress levels aren't for you, because you know what? While we constantly talk about the highest and best use of your resources, right? Why put $1 here and only make 8 cents a year on it when you could put $1 here and make 20 cents on it every year? But you know what? Maybe that's not for you. Maybe that move, making that process happen and work, adds stress to your life that you're not interested in, and you're perfectly happy with those 8 cents on the dollar. Great. Don't do that. Absolutely include in your, because I don't know what that number is for you, right? The only thing I can give you advice on is how do we figure out how hard our money is working for us, and then make suggestions on how to make it work harder for you. But maybe you don't want to do the work necessary to put it in that position, or maybe it introduces stresses in your life that you just don't need. You'd rather keep going the way you're going, enjoy the sunshine, have a picnic with the family. Perfectly reasonable. And that should absolutely, we've talked about making goals before. Family time, private time, being able to go off and surf, go climb a mountain, go ride a kayak, whatever is important to you. Those should all be included in any set of goals that you make for yourself on a yearly basis. And I hope all of you are doing that and staying up to date and keeping those goals current and at the front of your mind so that you're always working towards achieving them. All right, now the other little tidbit. Now that's a big one. I'm going to make that homework for everybody. If you haven't yet, go onto Google, create a news alert for yield curve and pay attention to it. Of course, as soon as I see something happen with the yield curve, you're going to hear about it from me. So I won't keep it a secret from you, I promise. Next, and this one is kind of interesting. This comes to us from our good friends over at Zero Hedge, and I know that there's a percentage of the time whenever we talk about Zero Hedge that I suggest everyone first put on your tinfoil hat, because you know you're about to take a ride sometimes when we're talking about Zero Hedge. Let me take another hit of caffeine before we get into it. Okay. And back on June 12th, 13th, we had the Fed meeting where they raised rates. And as always, I love it when I can actually point to something where I was proven right. What happened immediately after the announcement of the increase in rates? Lending rates went up. What now happened in the last week? Rates went down. So just constantly keep reminding yourself that there is an emotional link between what the Fed says they're going to make rates and what rates actually are. But like most emotional responses to something, they don't last, right? So in every case over the last 2 years, when we have entertained what's going to happen when the Fed raises rates, I've always said, do not lock in your rates for those first 2 weeks after the Fed announces a rate increase. You'll get an artificially high interest rate. And every single time I've been correct. I've been correct enough times, and because then it's not even me being correct, right? It's me just reading the cards from past actions and seeing that there is actually no direct link between what the Fed does with rates and lending rates. It's more about treasuries, right? We want to look at the treasuries for those. But wait, and eventually the emotion fades and everybody ends up reducing their rates. And you end up with rates that were actually lower than what they were prior to the increase in the prime rate, right? And that's what's happened. So great, just more proof that patience pays. What's interesting, though, is an observation that was made in this particular article about all of the Fed chiefs. And I thought it would be cool to share it with you. Now, first, it was Alan Greenspan, who famously wanted no part in popping bubbles, which he didn't believe should have any effect on monetary policy. He argued that the better approach is to wait for bubbles to pop naturally and then do whatever it takes to clean up the mess. Next, Ben Bernanke insisted that monetary policymakers shouldn't be expected to pop bubbles. In fact, he argued that the global financial crisis wasn't the FOMC's fault, largely because there was little it could do to contain bubbles. and it wouldn't have made much sense to change the bubble philosophy while at the same time denying there was anything wrong with it. Finally, the one we are most used to, because she's the one who's been in the seat most of the time, Janet Yellen. She also stressed macroprudential policies as the primary tool for achieving financial stability. She once delivered a speech titled Monetary Policy and Financial Stability, but she used the speech mostly to explain why responding to financial excesses through monetary policy can be a bad idea. In an earlier speech, she expressed hope that such policy interventions would be exceedingly rare, and in 4 years of post-meeting press conferences, she only once discussed a monetary policy response to financial excesses, and that was part of a vague answer to a question she ignored until it was asked a second time. In the article writer's opinion, she was never fully comfortable discussing financial excesses in the context of the FOMC's monetary policy decisions. All right. So, why is this interesting? Well, because we have a new head of the Fed, which brings in some new interesting approaches that could have a different dramatic effect on the markets as we know them. So the name we all need to know is Jerome Powell. According to the article, Jerome Powell delivered an important message that went largely unreported in this period of time when there was the meeting and the interest rate increase. If we take him at his word, we should expect him to respond much more aggressively than his predecessors did to financial excesses, and those aggressive responses will occur even without an inflation threat. According to this article, we should pay special attention to some of his opening comments in his statement that he made during the last meeting of the Fed. Quote, and remember what we just talked about with the previous heads of the Fed. Quote, "We are aware that raising rates too slowly might raise the risk that monetary policy would need to tighten abruptly down the road in response to an unexpectedly sharp increase in inflation or financial excesses, jeopardizing the economic expansion." So he shows in his I think it was his second statement as the head of the Fed, that financial excesses are something in need of a response, which is something we have not gotten from the past three heads of the Fed, which covers decades. Many of you were probably not born when we had Alan Greenspan as the head of the Fed. The article goes on to say, and the language in this sentence might seem ordinary if read quickly, but comparisons to what we would have heard from Yellen show it was a clear departure. So consider the following observations from this writer's review of Yellen's press conference as FOMC chair, beginning with her first in March 2014 and ending in December 2017. First, when discussing the Fed's response to an inflation threat, either real or hypothetical, Yellen never included financial excesses as a second possible trigger for policy tightening. She never volunteered any discussions at all about financial excesses or potential financial instability without first being prompted by a question about those topics. She only once acknowledged the possibility of the FOMC responding to financial excesses, but as noted above, that was part of an answer to a direct question that had to be asked twice. It was also in a, well, I would never rule anything out kind of way. So this indicates, just from the very first words out of his mouth, that he's taking a different approach. So Powell's opening statement wasn't just sort of status quo, what we've seen from the Fed in the past. Those three words, or financial excesses, never appeared in the same context in any of Yellen's 16 press conferences, let alone in the opening statement. That was just the beginning. Here's the next excerpt, this one in response to a question about wage growth. Quote, "Our role, though, is also to make sure that maximum employment happens in a context of price stability and financial stability, which is why we're gradually raising rates." Holy triple mandate, Batman, according to the writer. I count three goals in that sentence. Needless to say, Yellen never defined the Fed's role in the same way. She never elevated financial stability to a position alongside the traditional goals of full employment and stable prices. And take note, Powell was answering a question about wage growth. There was no prompting. So these are clearly things at the forefront of his mind. These are things he really cares about. Powell's language strayed not only from his predecessors, but also from his own prior comments. He spoke differently at his first FOMC press conference on March 21st than at the June press conference. In the earlier presser, he didn't deliver any warnings similar to those excerpted here. In any case, unless we missed an interview or an op-ed or a message in a bottle somewhere along the way, the June press conference offered the best look yet at Powell's thinking. The progression from March to May to June only adds to the sense that there's a process of carefully altering the Fed's message with regard to financial stability policies. So here's the conclusions that Zero Hedge comes to. The new Fed chief said that financial excesses are not only a monetary policy matter, but one that's first equal with employment and inflation. By implication, and according to the warnings excerpted in the article above, the FOMC could tighten policy in response to financial excesses, even if inflation was well behaved. Essentially, Powell announced he's not afraid to pop bubbles, meaning both asset price and credit bubbles. Depending on how far he decides to take it, he could even act to prevent bubbles before they inflate. Setting aside the trickier question of whether he'll be successful at something the Fed hasn't attempted in many years, he certainly gave us all a lot to think about. So I think it's super interesting to entertain an idea of we will not be in the status quo in terms of the Fed for a number of years. It'll be interesting seeing what they do differently. Over the course of this show, the prevailing wisdom has been what we've all gotten used to. So the ability to really anticipate what the Fed will or won't do, I think, is shaken up by Powell, by this new head of the Fed. We'll have to watch and see what actions he actually takes. There's often a big distance between what people say and what people do, particularly when he may want to do something, but he may be getting political stresses from other directions to do or not do things. So we'll see how things pan out. If he does become a guy who wants to pop bubbles, that could be really interesting. We already have some bubbles that are gigantic. A good example is the pension fund bubble. We've also got a student loan bubble. We've also got an auto loan bubble. We got a lot of different bubbles floating around. So it'll be interesting to see what he feels like doing in terms of popping those things. And no matter what he does, those kinds of actions are things that can cause an awful lot of uncertainty. And if you've been listening to the show for a long time, uncertainty for a long time has been the magic word. Uncertainty causes people to stop doing things. It causes them to try to save money, causes them to stop buying stuff. It causes fear. Uncertainty is a bad thing generally in a market. You like to have stability, but if you start seeing bubbles popping all over the place and those having negative effects, that can oftentimes be a self-fulfilling prophecy where the next bad thing happens because everyone sort of pulled away from the marketplace because they saw that last bubble burst. All right, so I think we should all just keep an eye on that. Absolutely keep an eye on that yield curve. And as always, the goal is to leave you with far more in knowledge than you invested in time. I hope we've done that. The yield curve alone, that's a super sexy bit of thing to keep track of, and absolutely a take action when you see it type of piece of data. So I hope you're all making note of that. Thanks again for listening, everybody. I'll talk to y'all next time.